People will often suggest or say we have a retirement crisis. And I push back pretty strongly because if you look at retirees, they are a very content bunch, and they tend to have incomes that are at least equal to or above where they were when they were working.
The economic environment the retirees find themselves in today is dramatically different than it was just 6 years ago, even just 2 or 3 years ago. And how do we view the future of interest rates? How do we view the future of inflation? And what impact will that make on retirement spending patterns and ultimately your retirement income strategy? Hey, this is Casey Weade, and welcome to the show, where it is my mission to deliver clarity and purpose and elevate meaning in your life. And if you're new to the show, I want you to know what to expect. We do this in a variety of different ways. We bring you both financial and non financial conversations on a variety of different topics. Week in and week out, we're bringing you a variety of these conversations with world class guests, like we're going to have today. This is one of those long form interview based podcasts. And I'm excited about this one because we're bringing someone back that was originally on the podcast back in 2019. We have David Blanchett here with us today. He is currently the managing director and portfolio manager, head of retirement research at PGIM DC Solutions. He was previously, when we interviewed him back in 2019, he was the head of retirement research at Morningstar. He is still the professor of wealth management and was my professor of wealth management at one point at the American College of Financial Services. And if you've been a weekend reading subscriber for some time, then you've read some of his work. We regularly include his writings in our emails that we send out to the families that rely on us for their retirement advice. And we also bring a lot of that research into the conversations that we're having with you week in and week out. He has won many awards for that research. He has received awards from the Academy of Financial Services, the CFP Board, the Financial Analyst Journal, the Financial Planning Association, and many more. What I'm really excited about today is we're going to be revisiting some of the discussion that we had 6 years ago. That was episode number 55. If you want to go back and listen to that episode, we're going to be bringing some of that research forward and taking a look at how it's evolved over the last 6 years. With that, David, welcome back to the show.
Thanks for having me.
Well, I'm excited to have you back, buddy. I think I probably read something that you put out almost every single week. There's maybe no other retirement researcher that I admire more than yourself. I love the content that you put out. You have a very academic, unbiased approach. These are the things that I believe we need in the world today. And I think in a lot of your writings that you put out, a lot of your tweets and posts on LinkedIn, I think we share some of the similar frustrations at the same time. And I wanted to start with something that I saw that seemed to be one of your frustrations. And you posted on LinkedIn recently with some frustration around news headlines, often throwing out the word crisis to describe the state of today's retirement, the retirement crisis. And you felt, and you said that you believe that challenge is a better descriptor. How do you compare and contrast between crisis and challenge?
Well, I think to start, one of the complications here is we all define crisis differently, right? Crisis is a very kind of personal term, but I view a crisis as like a really dire situation, right? So things are just, not good. And people will often suggest or say we have a retirement crisis. And I push back pretty strongly because if you look at retirees, they are a very content bunch, and they tend to have incomes that are at least equal to or above where they were when they were working. We as America have a very robust retirement system, Social Security, that is far more generous than other developed nations. And so if you look kind of collectively at retirement, we're actually in pretty good shape. Now, I'm sure we'll talk about, issues around the Social Security Trust Fund at some point today. But overall, I think that challenge is a better word than crisis because there are things that we should be doing to improve retirement. But I think the notion that kind of we're in this crisis state where Americans are destitute at old age doesn't reflect reality. Now, if we were to all of a sudden lose Social Security, I think that would be a crisis. But if you look at collectively how much Americans save, how much they spend, how they feel, retirement is actually, it's a pretty good place today, at least in America.
Mhm. It's kind of some of what we've heard over the years, and you often hear this from the oldest generation at any given point throughout history, talking about just how bad it's going to be for their kids, or how much worse it is today than it was in years past. But when you look at the numbers, you look at the research, we're living in a much better place than we were 100, 200 years ago, even 50 years ago. Now, if we go back to when we originally had our first interview back in 2019, there was something that often hit the headlines, which was the war on retirees. There's this war going on retirees, and that was really an emphasis on the 0% interest rate environment that we found ourselves in for many years. Now it's kind of flipped almost. The war is a little different. You don't hear about the war on retirees being framed up as it's an inflation problem today, but I wonder how you view that. Has the challenge gotten any easier over the last 6 years? We have much higher inflation than we had 6 years ago, but we've seen an easing of inflation coupled with higher interest rates. Now, if we go back 6 years ago, we still had these persistently high market valuations. Market valuations haven't shifted that much; they're still really high. And so, if we consider all of these things, we have, inflation that's higher, but we have interest rates that are higher, and then we still have the same market valuations. Like, has it changed really all that much on a relative basis, or is it kind of a wash?
So it's really tough. I don't think retirement is ever going to be easy, but I do think that interest rates have an interesting dynamic in our society, right? Older investors tend to invest more conservatively, and so when interest rates drop, they earn a lower return on their investments. Alternatively, interest rates, are really, higher rates are really negative for younger Americans, individuals who want to buy a home today. You're looking at, a 6.5, 7% interest rate on a 30-year mortgage. And so I think that higher interest rates, higher expected returns do help retirement, right? It makes it a little bit easier. But to your point, inflation is this really kind of new risk that hasn't been a concern among Americans when it comes to retirement for a long time. But if you look at surveys today, we just did a survey at the end of last year. We asked older Americans to select the number one threat to retirement security, among things like market returns, healthcare, longevity, and inflation. Inflation was selected number one more than
Mhm.
than all the others combined, and that's pretty new. Like I've been doing surveys on like what are you afraid of? What are your key threats for retirement for at least a decade, and it's usually like longevity or healthcare risk. But I think that inflation is this risk that's top of mind today that is somewhat new. And so think about how you actively address it as part of a retirement income plan is more important than ever.
And but what I continue to revisit, I go, yeah, but has relative inflation changed that much? If our interest rates are so much higher, the risk-free rate is so much higher today
Right.
that we might actually be in a better position than we were 6 years ago from the
Mhm.
difference between inflation and the risk-free rate.
It is. And so I think to me, this is more of that behavioral angle of like, how do you feel in retirement? And so, it's this really interesting dichotomy where people talk about a retirement crisis and how Americans don't have enough money saved for retirement and all these things. But retirees don't spend down their money. There's this massive disconnect, right? So people say, "Oh, we have this crisis and, retirees are in rough shape." Well, like if that were the case, you'd think they would leverage their savings more than they are. And so I think that to me, inflation is a risk more in terms of people's willingness to enjoy retirement and consume. When you're nervous about inflation, maybe you
Mm.
skip vacation, things like that. And so I don't view it as a risk in the same way I view like longevity risk as a risk. I view it more as a risk that it needs to be addressed as part of a plan so that someone can kind of more effectively enjoy their retirement.
So let's talk about how we address this. And as we get into this, I want to go back to the reason I brought you on in 2019. I want to talk about retirement spending patterns because that was kind of the groundbreaking research that I think has probably been the pinnacle of your research that more people have leveraged and talked about more than anything else. Doesn't mean it's the best
Yeah.
work you've ever done, but boy, I don't think there's any other piece of your research that has been more widely spread and things that we've talked about. And so I want to take for a second, I would like you to kind of revisit retirement spending patterns as the research was originally laid out, that impact. And then I kind of want to bring that forward. Now we're in a much different inflationary environment than we were back then when you did this research. Has that impacted the research? So take that where you will.
Sure. So a lot to unpack there. I guess, going back, so I used to be a financial advisor like a long, long time ago. And when you do a financial plan, what you typically assume is that an individual, will have a retirement period that lasts, say, 30 years, and that every year in retirement, they're going to increase their spending by inflation. And if you talk to advisors, if you talk to retirees, you don't often see them calling you up and saying, hey, the CPI went up 5.9% last year. I need a 5.9% raise. And there were some kind of models that were used, like there's this idea of the slow go, like the go, the slow go, and the no go years. It's a book by Michael Stein called The Prosperous Retirement. It's over 20 years old. And it's a really kind of clever way to think about how individuals or households change in retirement. When you're young, you can be active, you can go out and do things and spend money. But what we typically see is as individuals age, they tend to kind of slow down their consumption. And so, in this research, it was titled "Exploring the Retirement Consumption Puzzle," was published back in 2014 in the Journal of Financial Planning. It used a data set from what's called the Health and Retirement Study that observes the same households over time. So it goes back every 2 years and asks them all these questions, like 100 questions. It's a really intense survey. And what I looked at was, well, how do people actually adjust their spending over time? And what I found is that most Americans don't increase their spending by inflation. So it'll go up, but it won't go up with the full amount of inflation. So if, for example, inflation is 3% a year, people might spend 1% more on average. And why this is really important is if you kind of pull out retirement, if you think about retirement lasting, 20 or 30 years, this notion that you're going to spend less over time, what it can do is it can free up money you could spend earlier in retirement. And so to me, one of the kind of the key assumptions we use in retirement planning, which is that individuals, increase their spending by inflation, doesn't tend to track reality. Now, to be fair, some individuals do spend even more than inflation, some spend even less. The key is that kind of the average trend is that spending tends to decrease in today's dollars as we move through retirement. And so, our earlier talk about inflation. So inflation is still very much a risk. But I do think that it's worth revisiting this notion that, hey, I'm going to increase my spending every year by inflation. Because what it does is it maybe would allow someone to spend more early in retirement when they can better enjoy their savings.
Mhm. So when I think what's getting harder about this, we used to have this conversation, I mean, for many years in different mediums and with clients and prospects and on radio shows and TV. We talk about this research and how, we're planning for retirement expenses to go up at 3% a year. You're planning for them to double over 20 years. But I've worked with clients for 20 years and I've never seen any of them double their expenses over 20 years, let alone even spend anymore 20 years into retirement. And I think that was easy for people to stomach and accept when inflation was 1, 2, even 3%. They started seeing inflation rates over 4%, and then they go, I think it's harder for them to accept that that could possibly be reality. And how do you battle that, or how do you think about that? How do you address that question?
So to me, there appears to be just some active choice in this. And so, yes, like if inflation is higher, you are going to spend more, but the odds are you're not going to increase the full amount with inflation, right? And there's reasons for that. I mean, one is just the substitution effect, right? If things start costing more, you might choose to do something else, right? As opposed to, I don't know, going to Florida for a vacation, you'll go somewhere closer. And so I think that the key here is that retirees have varying levels of flexibility. And I think what's really important is retirees who have the most wealth typically have the most flexibility. Most or a good portion of their spending or consumption is in things that they can change. They can choose to not eat out. They can choose to do things. And when you have that level of flexibility, it allows you to have more choices. And to me, the key here is not that you have to spend less. It's how can I free up more money for you earlier in retirement so that you can actively enjoy it. The last thing I want someone to do is to start retirement super conservative, not spend as much as they possibly could, then have a health issue at 75, and then they're kind of stuck. Yes, they have this large pool of money, but saving in 401ks is not fun. I don't enjoy saving for retirement. I'd rather go, blow the money on a vacation, but I'm not going to do that. I want to be responsible. So what I don't want to have happen is individuals save, be really good savers for 20 or 30 or 40 years, get to retirement, be afraid to use their savings, and then all of a sudden they realize 10 years in, they're 75 years old, that, oh, I could have spent a lot more money and done a lot more things. So to me, it's about this balance of understanding that, yes, we want to, prepare ourselves for a long possible retirement, but we also want to enjoy retirement as much as we possibly can. Of
Well, in order to do all that, we have to factor in an inflation rate. I mean, you're
course.
going to have them factor in a lower inflation rate that shows that they can spend more today. So brass tacks is, what inflation rate should the average retiree be using in their retirement projections?
So, I think a long-term inflation rate between 2 and 3% is pretty reasonable. Right. And so now it's obviously now like a fun point here is technically when you do a retirement projection, there's different ways that you can treat inflation. Okay. You can treat inflation as a static variable. So it goes up a constant amount per year. More advanced modeling tools treat it as random. So some years it goes up 4%, some years it goes up 2%, some years it goes up 1%, et cetera. I think the key is one is using a reasonable long-term assumption. The best way to do this typically, if you're thinking about a retirement plan, is to have two different sets of assumptions. Kind of like a near-term assumption, like what's going to happen the next like 1 to 10 years, and then say like a year's 11 to 30. And why that's so important is, if we go back to 2019 and we had super low interest rates, okay, you might want to assume a lower interest rate on your investments, a lower inflation rate, for that period. But, longer term, I think things tend to move back to the long-term average. Now, like what's important too about inflation is that, if you have every American has Social Security. So you have a lifetime income indexed to inflation. If you have investments that are invested in a way to benefit from inflation, inflation doesn't have to be that big of a risk. The key is how are you thinking about managing as part of your overall retirement income plan? If you're ignoring it, then yes, it can become an issue. But I'm less concerned about inflation if it's higher. Again, if you have that flexibility, if you've built a portfolio and a retirement plan that actively considers what would happen if inflation's above average.
So if we take, for instance, let's say the long-term average of inflation's 3%. We know it's around 3%.
Yep.
And we say the average retiree is going to spend about 2% less per year. So does that mean that they should be using a 1% inflation rate in that strategy?
So you can, like I still think it's totally fine to just assume it increases by inflation, right? There are some big elephants in the room, like where are healthcare costs going? So while it is true that Americans tend to spend less in total as they age, they allocate more of their spending towards healthcare, right? So about 10% of total household expenditures goes to healthcare at 65. It's closer to 20% at age 65. It's very possible that could increase further in the future, right? No one knows what's going to happen. Long-term care is this huge risk. And so I think to me, where that assumption around spending less comes into play is maybe helping someone that is a bit constrained when they get to retirement. They haven't saved enough. How do I free up money? Stuff like that. So I think one, it's totally fine to use for all financial plans. But people, in my experience, will often say, "Whoa, like I don't want to assume I'm going to spend less." And so I think like that's fine. But having like a secondary plan to kind of let someone know, hey, there's a really good chance that you're not going to increase your spending every year by inflation, especially when you're older. And so what would that mean in terms of you doing more today and understanding just the trade-offs? That's where I think this kind of modeling is really important, just to give someone a better perspective on, hey, it's probably okay to spend a little bit more now because you're probably not going to spend more later.
And I think what I've seen, I mean, if I look at the clients that have been working with us for 20 plus years, it, we they are, if you just build a level income strategy. So from their portfolio, they're getting a level income, but then they still have typically half of their income in retirement's coming from Social Security, say. Well, they're automatically getting those cost of living adjustments and Social Security. And so their overall net income is still increasing by, say, 1% per
Right.
year on average. And so I think that's what gets built in there. We go, hey, let's plan on 1% or let's plan on 2%. And most of those cost of living adjustments are going to be taken care of by your Social Security benefits. But then we still need to guard against a worst case scenario. It's much like guarding against a down market in the first 10 years of retirement. I mean, you want to guard against the worst case scenario. And we can say, hey, David's research looks really good, looks really solid. However, what if he's wrong? What if inflation is substantially higher than it's been in the past? We need to have a strategy for that. So
Mhm.
then do you encourage retirees to create some type of hedge in their portfolio, set a portion of assets aside in a bucket that can outpace inflation, such as equities or tips or real estate alternative investments that we know will, keep pace or outpace inflation so that we can make adjustments if we ever need to? And if so, how much do they set aside specifically for that purpose?
Yeah, so this is kind of difficult because there's a risk spectrum here, right? If you want a really good inflation hedge, you should buy tips, right? Tips, are one of the few investments that exist today, treasury inflation linked securities that provide a guaranteed return plus an inflation hedge. The problem is that there's no kind of risk premium there beyond effectively inflation. So they might keep pace with inflation, but long term you might be better off investing in equities. And so to me, the key is allocating, part of the portfolio to these, real assets. And so that would include tips, it would include maybe commodities, maybe real estate, but also equities and more traditional asset classes. Because I think that if you look at, so I just had some research come out and looks at how do different investments do over different time horizons. So there's lots of ways that I'm a portfolio manager. You can build portfolios. You run these kind of fancy optimization routines. What we generally assume in these models is that returns are effectively independent or random over time, right? So the return of the stock market last year is not related to the stock market next year. Well, that's actually not true, right? Stock markets kind of move in a cyclical way. They go up and they go down, they go up and they go down. And one thing if you look at historical data, is that certain asset classes become more attractive inflation hedges the longer that you hold them. And so, I won't get too into the research, but I think to me, what the key is for retirees especially, is a very well diversified portfolio with explicit allocations to asset classes like tips, to commodities, to real estate, maybe infrastructure, because those asset classes, they aren't going to be as efficient for someone who's in accumulation. Because when you're young, your human capital, which is your ability to go out and work, is your most effective inflation hedge. But as you age and you deplete your human capital, you often need different investments in your portfolio to kind of think, how it will most effectively help you accomplish your goal. And so I wouldn't lean all into equities. I wouldn't lean all into tips. I think it really does take a diversified portfolio that's thoughtful to, address inflation risk.
What I feel that people should take away from this is build a strategy that's based on a conservative inflation rate and then set assets aside that can be there to hedge the risk that inflation's higher than you expect it to be. And I appreciate that. And I think that's going to be very valuable to a lot of folks. Now let's shift our focus specifically to interest rates. And now we're in a higher interest rate period, and we're seeing a lot of folks that are coming in saying, "Hey, I've got these CDs that are coming due, or interest rates. I'm not getting the same interest rate I was getting 12 months ago. What should I do?" Is now the time, I guess, and you can take this and even discuss kind of the future of interest rates and how you see interest rates changing here over the next, say, 5 to 10 years. But I think people are asking themselves, should I start locking in these interest rates for a longer period of time? I was going to the bank and getting a 6 month, 12-month CD that was paying 5.5%. Now, as interest rates coming down a little bit, should I be locking these funds in at higher interest rates for 5, 10, 15, even 20 years?
Yeah, I mean, I think it's really difficult to predict where rates are headed, right? I think last year's a great example. Early in the year, there was, significant predictions about rate cuts. We didn't see those materialize. I think there's still, one or two more rate cuts forecasted in 2025. But that could all change, right? If inflation becomes an issue because of, tariffs, whatever else that happens, we could see interest rates rise. And I think that one thing that is, still kind of novel today is this high interest rates that you can get on cash. That's not historically, hasn't lasted very long. And so, I understand why some investors may want to lean more into cash today, but typically what's happened is when we get a more normal yield curve and you're seeing cash, returning 2 to 3% less than intermediate bonds, that happens pretty quick. And so, again, I don't know like where things are headed. I think we could have rates go way up or way down in a year or two. A lot of variability right now, I think. And I think that's why kind of locking it in to, at least part of the portfolio into something that's more intermediate or long-term in nature is just a smart play. Like, yes, it'd be great if you can earn 5% on cash forever. Probably not going to happen. And when interest rates move, the cost of the move, if or when they decline, especially for cash, can be pretty significant long term. So I'm not a big fan of market timing. I think things were different when the curve was more inverted. Now that we've seen more of a normalization, I do believe kind of addressing what you're doing with your cash is really important because if rates fall, there could be a pretty big opportunity cost.
Well, and I think most retirees, I mean, and traditionally, my grandparents would have said, "Well, I'm going to buy a 5-year CD then." So we go out and buy a CD. What is the best if we're thinking, yes, I do want to lock in some of the current interest rates on my cash at a higher rate of return? Do we look at CDs? Do we look at annuities? Do we look at bonds? What are the best tools to do so?
I mean, I think it depends upon on everyone's unique situation. So, I think that CDs can be great if you can get a good rate. There's an annuity that's called a MIGA, a multi-year guaranteed annuity. It's like a CD that offers a guaranteed rate for a fixed term. Those can be attractive. Just your more traditional core bond funds, I think, can work as well. So I don't know that I have a strong preference. I think that, things like taxes can be really important. So, for example, if I'm going to own this in a taxable account, and I have a relatively high income, well, an annuity that offers a guaranteed return might be more attractive because I don't have to pay tax on that gain every single year. If it's in a qualified account like an IRA or 401k, maybe just a more traditional core bond fund could be fine too. So I don't know that I have kind of a strong preference about where individuals get that fixed exposure. It really depends upon their overall situation, their preferences, their tax situation, et cetera.
Now, there was an article you wrote in February of last year, so almost exactly 12 months ago. It was exactly 12 months ago. You had
Okay.
an article in Kiplinger, and you expressed that in comparison to cash yields, cash yields were, I think, higher than they
They
are
were.
today,
Yep.
and you said equities are still a better long-term bet. And I look at that, and I said, isn't it kind of, well, when you think about that, I just think it's hard for people to justify still to allocate to equities when they can, the risk premium isn't there, right?
Correct.
They go, well, when interest rates were 1%, then I was looking at long-term averages of equities at 7 to 10%. Yeah, I'm better off in equities. If I can get a risk-free 4 to 6%, then well, is it really worth allocating to equities for another 1 to 2%? How do you think about that?
So, I think 2024 is a great example. Right? If you looked at market predictions, Jan 1, 2024, I think most people had S&P like flatter down, right? S&P was up 25%. And
Yeah.
so, it cannot do that forever, right? That's just not realistic. I mean, maybe it could happen. I don't know. But I think the key is understanding your risk tolerance and maintaining that diversified exposure. I think what we've all seen is someone is convinced that the market, is due for a crash, and they exit too early and they miss years like 2024. And then
Or they look at it and they've got 80% in equities and they go, I'm going to go ahead and set 20% aside in fixed income because I'm making, it's only 2%
well, that's
difference.
good.
I'm making 5%.
And so I think to me that's where diversification is so important for retirees. I really like, I don't want to say like 50-50 is right for everyone, but like a really I mean, the diversification matters the most in retirement. And so I do think that having equities is really important as a long-term structural inflation hedge. And so equities do become the risk of equities actually declines in relative terms the longer that you hold them because of the cyclical nature of markets. So if you can stay invested for a 5 or 10 year time period, equities become relatively safe or safe-ish compared to fixed income. The problem becomes if you're going to trade out of the market, if you're going to react to market volatility, or if you need the money. Then it becomes more of a no-brainer. Yes, you should invest most or all of your money in cash or bonds. But I do think that retirement is an unknown period that could last 30 or more years. And so having equities, I think, is a really good kind of long-term hedge against longevity risk, against inflation risk, things like that. So I wouldn't go overboard because a lot of people have a hard time with the volatility. But I do think maintaining especially if you're a younger retiree, half-ish of your portfolio in equities is a smart long-term play.
Mhm. Do you think that today, given a much tighter risk premium than we had in the past, yeah, I mean, combine that with market valuations that have been sustained, do you expect that that will impact at least near-term future equity returns?
Yeah, I think everyone does. If you look at, I love to look at, capital market assumptions. We do them at PGIM. Other asset managers create them. They are probably at or near their lowest they've been in an awful long time. Right. Again, like I think there was the expectation in 2014 the markets wouldn't do well. They did quite well. And I think that when you kind of factor all this in, it just suggests that valuations are really high. So, I mean, it's very possible that tomorrow, or next week, we enter a massive bear market, that markets go down 50%. I think it's also possible that our economy booms and we see more years of plus 25%. And so I think that to me, the key is looking, myself in the mirror if I'm a retiree, doing an honest assessment. Hey, like how much can I afford to lose here before I start to panic? And that should have a big impact on the portfolio, because I have done research, and what I have found is that older retirees, without a doubt, or older Americans, react the most to market volatility. I've looked at multiple market cycles, multiple groups of investors, participants, and overwhelmingly, older Americans respond more to volatility. I think that's because like the impact of the drop is a lot more salient. If I'm 40 years old, my portfolio goes down, it's like whatever, it's for retirement, I don't need it. But I think that people feel the risk more when they're older. And so that's why, being all in equities might sound great, but if you can't sleep at night and you're worried about it, then it's not the right portfolio for you.
Hmm. Yeah, let's shift a little bit over to the 4% rule, because there was some recent research that you did at PGIM regarding the validity of the 4% rule. You found that the 5% might be a better starting place, and that's changed so much over the last 5 to 10 years. It was 2.5, then it was 3.5, and some people said it was 1.5, and now we have research saying, well, it's 5% today. And I think that's hard for retirees to go, how do I plan for this when it's always in flux? Like when it was, and are you saying, I guess as part of this research is probably where we need to go first. When you say it's 5% today, is that a factor of retiree spending patterns, or is that a factor of current interest rates, or is it a combination of the two?
It's a factor of that and a holistic retiree balance sheet. And so, maybe just to define terms, right? The 4% rule came out over 30 years ago, researched by Bill Bengen. And, all it really tells you is when you retire, if you were going to assume a 30-year retirement period, you can take out 4% in the first year of retirement and then increase the amount every year by inflation. Okay. What I've been looking at more is, well, what are the assumptions that we used to determine that? And so, for example, the 4% rule, in most retirement financial planning calculators use success rates as the outcome metric. Okay. Success rates, how it works is what you'll do is you do what's called a Monte Carlo simulation. You'll just kind of treat some variable like market returns as random, because we don't know what's going to happen in the markets. Okay. And then what it does is it looks at, did I accomplish my goal in its entirety? And if so, I will kind of assume that that's a one. Like you got that amount. If not, if you don't accomplish the goal in its entirety, it's a zero. Okay. And the success rate is the percentage of runs or trials that you accomplish your goal. A huge problem with success rates as an outcomes metric is you could fall $1 short in the 35th year of retirement, and it would suggest that you failed. Right. And that's not failure. And so when we think about how we define outcomes, it can have a huge impact on what we do, right? In reality, what we need to think about is, well, what is the actual impact on a retiree if they have to make a change? And in that context, let's think about like the holistic balance sheet. There's the assets and the liability. Okay, we think about funding retirement. Households have guaranteed lifetime income, probably Social Security, maybe a DB plan, public pension, whatever. Then they have their savings, so their 401k, their IRA. The liability is this idea of like essential expenses and then flexible expenses. Okay, if you mash those together, think about the role of the portfolio. We actually talked about this earlier. The role of the portfolio for most retirees is to fund more flexible expenses, things that they're more okay to cut back on. So when we think about the role of the portfolio, how we quantify outcomes, what we're doing here, I think that 4% is overly conservative. It's resulting in outcomes that overwhelmingly suggest that you could spend more than you did initially. But there are lots of important variables here, like, how flexible are you as a retiree cutting back on your spending? What is your existing amount of guaranteed lifetime income? But if you mash all this together and build a better kind of way to think about, how do we feel about accomplishing goals? What does it mean to cut back? I think that 5% today is a better starting place. Now, the idea behind that, though, is that you're going to come back every year and reassess what that number should be, right?
Hmm.
Because it could go to 5.5%. If all of a sudden interest rates go way up and valuations improve, it'll go up. It could also go down. But to me, 5% is just kind of like generalized average. So the average retiree, given their average situation, that's a good place to start. But now there are going to be some retirees that don't have a lot of guaranteed lifetime income, that have a lot of flexibility, where 4% is the right number for them. The key is kind of understanding where you sit in terms of your situation, and then picking the right withdrawal rate based upon what's best for you.
Yeah. Well, in general, I think the application, the 4% rule is a rule of thumb for those that are a ways out from retirement, at least
Yeah,
10 years, 20, 30 years out, 40 years out. I mean, trying to figure out how much you should save, then yeah, 4% is a great starting point.
sure.
Are you suggesting that even those that are really far out from retirement should start thinking more about 5% instead of 4%, and the 5% just becomes a universal standard?
I do. I mean, I think so. Again, like if, it really should have been called the 25 times rule. So some quick math, 1 divided by 4% is 25. That's really all it tells you is how much you have to have saved in the first year of retirement. The 4% only applies to the year one withdrawal. That amount is then increased by inflation. So after the first year, the percentage becomes irrelevant. Okay, it really should have been called like the 25 times rule, where whatever income you need to generate from your savings that you don't get from Social Security, you need 25 times that value. I think that 20 times the value is probably a more realistic starting place. But, I fully acknowledge that that's going to change over time. And that, it's really hard to kind of think, oh, I'm going to, exactly hit my savings goal at age 65. People tend to retire early. A lot of things happen. But if you look at like the range of recommendations out there, you see withdrawal rate recommendations between like 2% and 8%. Um, I think 2% is way too conservative. If you do 2%, there's a really, really good chance you're going to have a massive pot of money when you die. I guess that's okay if that's your goal. If you use 8%, there's a really good chance you have to cut back significantly during retirement. To me, 5% is this kind of better balance. And again, like the key, like what's the deal between 4 or 5%? Well, like I think what's really important is where we start when we first retire kind of begins this trajectory that we go down. Like those initial spending amounts become kind of sticky over time. So people kind of get used to a certain lifestyle. What I want to do is kind of balance this need to possibly cut back if they need to and enjoy as much as they can today.
Hmm. Yeah, well, a couple things there, and one is I think for those that started retirement years ago, maybe you're using a 2 or 3% withdrawal approach, make sure you're readjusting and reassessing where you stand every single year and changing that number potentially. Also, another thing you mentioned there was having flexibility in our spending in retirement. And there's just been kind of a proliferation of income strategies, I feel like, especially over the last 5 years. I mean, when I started, it was the 4% rule, and then there was kind of this bucket approach that kind of came into play, and now there's a litany of other other types of strategies we could be using, and I think it gets a little bit overwhelming. One of those is the kind of a flexible spending approach. You have guidance, kind of guardrails,
Sure.
and you just kind of said something there that I don't want to get overlooked. You said people get used to a certain level of spending. So if you're pulling $40,000 out of your portfolio, you you're probably not going to adjust that. And I think the things we define as discretionary become not so discretionary when rubber meets the road. Yeah,
Right.
I'm going on that vacation with the kids, and I'm
Mhm.
I'm keeping the country club membership. And so that's where I kind of struggle with the guardrail approach, saying, oh, well, we'll just adjust your spending by $5,000 this year, and you're going to spend less this year. In practice, in reality, I mean, I don't know that that strategy's had to make much in the way of adjustments since it's
Right.
come to be. What's going to happen when people that are on the strategy all of a sudden get hit with this reality that this was a strategy you chose? Now you're going to have to take a pay cut.
Mhm. So, I think realistically, no matter what you do, you're going to apply guardrail to whether you take out 3% and it becomes, $1 million, that's $30,000 a year, or it's $80,000 a year, right? In theory, you're going to guardrail it. But what to me, what I worry about, and we use, we can use air quotes around worry, is that, if you picked $30,000, you picked 3%, there's a really good chance that you're going to you could guardrail up every single year. And so maybe they all end up at a similar place. The 80,000 ends up dropping significantly to say 60,000. The 30 makes its way up to 60. Well, you didn't do a lot of the things that you could have done when you first retire. So I mean, I think that there's this implicit assumption that you're going to make dynamic adjustments to some extent. To me, it's balancing, you know, how much can you spend when you first retire, knowing that you don't want to cut back unless you have to, but you also want to do as much as you possibly can. So to me, those are all kind of things that we're balancing, and that's where I do think that 5% is just a more realistic starting point, because a huge problem with the 4% rule is it assumes that you're like if you fall a penny short, you're like destitute. Well, like every American effectively has guaranteed lifetime income. So even if your portfolio went to zero, you'd still have something. And realistically, you're going to make dynamic adjustments over time. So to me, this is about kind of finding a better starting point for retirement than just saying 4% is the number for everyone. It's not. And I think it's probably a bit too conservative.
hmm Well, then let's say we're trying to find the right strategy at the inception of retirement. Where you pointed, there was some research that you had that about 50% of retirees plan to live off portfolio income exclusively. So is it living off dividends or living off portfolio income? Is it the guardrails approach? Is it the flooring approach? Is it the bucket approach? How does a retiree digest all this and land at the right strategy for them?
I think that like that's where having an advisor to kind of do a gut check every year is really important. I think a really good rule of thumb to ask yourself, like, hey, like, is my withdrawal rate or amount correct from a portfolio? Is just to kind of go online and do a good online calculator for life expectancy. So how long do you think you're going to live? One divided by that number is a pretty reasonable approximation of what you should be taking out. Now that's the RMD rule, right? But don't use the government table. Use a calculator that's based upon your situation. Use one that incorporates your health, your income, your wealth, things like that. And that's not a terrible, benchmark for, what should I be taking out? So, when you first retire, your life expectancy might be 23, 24 years. What would that suggest? Like a, 4.5-ish% withdrawal rate. That's a good gut check, because what I worry about is you move into retirement, people have this fixation of 4%. It's not 4% when you're 75 years old. It could be like 7 or 8%. And that could be too high for some folks. But to me, a gut check on spending from a portfolio is this kind of dynamic updating process. And the easiest rule of thumb, it's called the modified RMD rule. It's just 1 over some period where ideally that period is defined based upon your kind of longevity period for retirement.
Hmm. So let's I want to see what your strategy would be here. So specifically, I mean, we've talked a lot about this 4% rule
Mhm.
or 5% rule today, but there's lifetime guaranteed income. There's an RMD approach. There's dividend approach. There's this bucket approach or a flooring approach. I mean, when I know we're about the same age, but let's say that you were about to retire tomorrow, yeah, and you may be a little biased as a portfolio manager, and feel free to explain that. But and I carry my own bias as well. We all do. What would
Mhm.
be your bias that would lead you to a specific strategy, and why would you choose that strategy for your own retirement?
Well, I think that there's some important things that we should all acknowledge when it comes to planning for retirement. Like one is that we are going to change and things are going to happen, right? So you could suffer cognitive issues, we could suffer from a host of issues, right? And so within our household, I tend to take care of most of the investment stuff. And I think that, I strongly believe that, most Americans should have lifetime income that is at least equivalent to their essential expenses. So what do you absolutely need to have covered? And then get a paycheck for that. For most Americans, you can get that from delayed claim of Social Security, right? For other Americans, you might need to, go out and buy some kind of lifetime income annuity. There's lots of options there. We won't go down that road. But I think what I'll be looking at doing is delaying claiming so well. I guess we're assuming as of today. If today I would want to delay claiming as long as I possibly can. I would likely even buy more lifetime income via some product. I might even buy a longevity insurance, and then I would invest the rest. And I mean, I'm pretty good at managing portfolios, but I also don't have to worry about it. What if I live a long time? What if it happens to me? I want it to be easy. So I do think there's an important role for lifetime income because it is this kind of ultimate easy button on retirement.
Hmm.
That
Well,
being said, like you shouldn't probably have all your money in lifetime income. You should have
yeah.
a good portion that's in a portfolio. But I think that understanding what your spending profile looks like is just so important when thinking about how to structure lifetime income versus pulling money from a portfolio.
Well, that's a great transition to your license suspend research that you did alongside of Michael Finca, who discussed it with us briefly back in episode number 451 of the podcast. But I want to kind of revisit this from your perspective. And maybe you need to rewind, kind of define license suspend too. Feel free to do that as we get started. The question here is really, annuities become a license to spend for retirees, meaning that they tend to spend twice as much every year in retirement if they hold guaranteed income versus investment wealth. Is that inherent license to spend or them spending more in retirement, is that simply an element of them having that guaranteed income every month, or is that an element of portfolio optimization? You have more optimal portfolio allocation, and that's why you're able to spend more.
So like there's a lot there. Like maybe taking a step back, like, for those of us that like actively research retirement income, lifetime income annuities are usually deemed to be relatively attractive, right? This collective movement in our society towards defined contribution plans, 401ks, 403bs, IRAs. I think it makes a lot of sense for companies. If I had a company, I'm not going to offer a defined benefit plan. But it's really inefficient for every American because we have to all of a sudden plan to live to age 95, age 100, age 105. And so there's like 50 plus years of research from tons of economists that have suggested that, hey, in retirement, it is much more efficient to pool longevity risk via some kind of product or strategy or solution than it is to have each individual having to worry about living a really long time in retirement. And so if you look at the body of research, everyone's like, wow, like lifetime income annuities make a ton of economic sense. Okay. That's the more kind of like classical economic perspective on why allocate to lifetime income. And to be clear, like that includes delayed claim of Social Security. I think the first place that every American should look when it comes to lifetime income is delayed claim of Social Security. Okay. It could also mean allocating savings to buy a lifetime income annuity. Okay, this new research I've been doing with Michael, we have the original piece was called Guaranteed Income, a License to Spend. We have a new piece that came out a few months ago, very much along the same lines. And what both these look at is how do retirees actually deploy their wealth when they retire in terms of spending? Are they more willing to spend from certain assets than others? And to be clear, like we can't ask them questions. We can't say like, "Hey, what are you doing?" What we can do though, we have thousands of retirees, and what we know how much they have in their IRA, how much they have in their taxable account, how much they get in terms of lifetime income, capital income, and wage income. We can run these sophisticated regressions, these mathematical models, whatever. And what we can look at is, well, how are these different assets, and assets is being defined as both as like the 401k balance and income sources. How do households use these different potential sources of income to actually consume in retirement? What we find is there is significant evidence that retirees are much more likely to spend lifetime income than any other income source or asset, roughly by double. And so for every dollar, let's just say every dollar that they get of lifetime income, they spend about a dollar. Okay, for every dollar they get of wage income, they spend about 50 cents. Every dollar of capital income, about 50 cents. If you look at withdrawal rates from the portfolios, they're about half of what you would even generally recommend as optimal based upon the household structure. So what the evidence suggests is that households are far more willing to spend lifetime income than other sources of wealth when they retire. And why I think this is a bit different than what I've done before is before I love to do these complex routines focused on how much should you withdraw from your portfolio? Is it 5% or 4.7%? Like whatever. Okay. This is looking at actual retiree behaviors. And so what this suggests is that not only is there kind of academic evidence for the value of lifetime income, there's also this behavioral evidence that you'll actually be more willing to spend money in retirement the more you have in lifetime income.
One of the things that I talk about where we're at today, in higher interest rate environment, are annuities more attractive? Is now a better time to own an annuity, or should we be looking more towards lifetime income if we were owning annuities that weren't lifetime income based because of higher interest rates, locking in those higher interest rates that we have today? But going to an insurance news net article that you had, it had a little research around the misunderstanding of annuities. What I found interesting was that 60% of respondents in their 40s were interested in annuities, 20% of those in their 70s. And I mean, you would expect that to be inverted at the very least. I mean, typically, and I think it's pointing to saying that the older individuals misunderstand annuities. I kind of pointed that research. I'm like, sounds like younger individuals misunderstand annuities too.
Well, it's funny if you look at those surveys, it's kind of persistent over time. Like if you ask people like, do you want to buy a product that provides guaranteed lifetime income? And this has been they've been asking these questions for like decades. And younger people are like, yeah, like that sounds really, really great. Older Americans are kind of like, I don't want to do that. And so I think that happens for a
And you're
host of
saying that the numbers have been very persistent over
there's
time.
been a
That hasn't
slight
shifted.
a slight increase among older Americans, but that kind of like effect where like it's like 60% of like 40-year-olds are like, yeah, that sounds awesome, but only like 20% of 75-year-olds. Like that, like those numbers, like, because you might think, oh, well, like when those 40-year-olds get older, like there's going to be this massive increase in interest. Well, no, it
Yeah.
tends to just like it just as people have aged into it, like this as they age, like they have like the same perspective. Like I don't do that. But like so my issue is that like I understand the issue. Like a lot of the products, they're irrevocable. Like it's really hard to kind of make this transfer. And so I think it's there's a possibility, like we could see some future legislation here. Like, like one thing that I kind of like is this idea like all employer contributions would need to be annuitized upon retirement or something along those lines. I think it'd be really hard to kind of make
Yeah.
people, like annuitize, quote unquote. There's different ways you can do it, their savings, but like, getting more Americans to allocate, more of their wealth into lifetime income, which again, delayed claim of Social Security, buying a lifetime income annuity, I think it'll actually make like as a country like better off because we're going to spend more, we're going to enjoy retirement more, things like that. So I think there are some like interesting societal issues here that we could see some legislation on eventually. But like long story short, I think that the actual behavioral benefits of lifetime income are more than the economic benefits. So even if you don't buy like the benefits of mortality pooling and all that, like just the fact that you don't have to worry about what you need to spend because you've got income guaranteed for life, that to me is probably the bigger justification to consider them today.
Do you think that when you look at this and how it shifts, so these 40-year-old respondents, all of a sudden they go from 60% are likely and they love the idea of getting guaranteed income, then it goes down to I don't know what the numbers are in their 60s, maybe it's around 30% or something like that. Yeah, but the numbers going down. Do you
Mhm.
think that what's happening, how I kind of think about what's happening over that period of time is, well, they didn't have that much when they were 45.
Mhm.
Now they're 65 and they go, man, I've got quite a bit today. Now that they have more in assets, there's two things that have happened. One is it's now that's kind of become part of their sense of worth, that
Mhm.
net worth has become part of their sense of worth or their identity even. And they've also spent 20 years now, 20 more years focusing on accumulation, and it's harder to shift to income.
Right. So, and that's why I think, we don't have many of these products today, but, again, I'll use the word annuity generally here, like annuities that kind of wrap portfolios that allow them to exist, like wherever you manage them, like we don't have to
Mm,
transfer money to the insurance company. I think those are going to
mm.
be a huge area of growth in the future, right? People want longevity protection. Advisors want to keep assets in their native custodial environment. So I think that, having solutions that kind of blend together like, yes, like I'll pay an extra 1% a year for this annuity, but I want to manage the portfolio my way and do it how I've been doing it, not have to move it all over to, Prudential or whomever. So I think that we are seeing more innovative products being created that will make individuals more interested in utilizing annuities as part of their retirement income strategy.
That's interesting. That's a new one for me, and it's and maybe this is the answer to a couple of one of our. I've got a couple wrap up questions for you, and maybe you just stated this one, but maybe you didn't either. And so my question as we bring things to a close is, if you could change one thing about how financial planning is practiced today, what would it be?
Yeah, I mean, I think that like to me, it's somewhat siloed where we have advisors that focus their value prop on building portfolios. Other advisors just sell products. I really wish that we would all kind of come together and provide more holistic retirement income planning, right? I have all these people randomly email me, like friends, like strangers, and usually what happens is they meet with a financial advisor. We'll just use air quotes there, but they're not really an advisor. They're selling a product, they're building a portfolio, and it's not really a holistic solution. I remember one time I met with someone and it was actually a pretty good product, but my question is like to my friend, I was like, well, how did he determine this was for you? He's like, well, he just presented this. I'm like, well, even if it's the right product, like it wasn't the right process. Like you didn't ask the right questions. And so like maybe eventually it'll make sense, but like why would you buy something if like this is most of your retirement savings and you didn't do like a full discovery on like what is your actual situation? So I think that, and we're already seeing this, but I just want our industry to evolve more into more of a comprehensive financial planning, advising domain where advisors are actively using all the solutions that exist. So they're talking about building efficient portfolios, they're talking about lifetime income to truly help, especially retirees, get the best plan for them.
Absolutely. And I think we've been heading that way. I mean, I
Yeah.
think if you rewind it back to, the early 2000s, I mean, the only people that were talking about guaranteed income were those that were had an insurance license only, and they're selling annuities. Everything needed an annuity. And I think now you're seeing, certified financial planner practitioners, true financial planning firms going, all of these tools are
Yep.
valuable. We just need to go through the right process to find what the right tools are for you in your unique situations. I hope we're headed in the right direction. I think we're headed in a much better direction. And now I have a selfish question for you. I know you have 4 kids. They're about the same age as my children. And being someone that is always around the money, always thinking about finances. And we have a lot of listeners that have grandkids, a lot of listeners have kids, and they want to know, what are some things that I can do to ensure that my children are going to be equipped financially in order to operate in this world? What are some unique things or methods or strategies that you use with your kids to ensure that they're on that right path?
Well, so my kids are between the ages of effectively like 6 and 12. So I guess I'm doing things that I think will help them, but it's far too early in the game to see if it's actually going to work out. So that question would be better served to ask parents that have older kids. I mean, I think what we're trying to do is make them very aware of what things cost, what an allowance is, what they want to spend money on. And I'm not like making them save money for retirement today. It's just more kind of general awareness around the importance of saving, what you're spending on, things like that. So to the extent that we're successful, we'll see. I do have some more kind of colorful initiatives planned in the future about like saving money to buy a car, like how we're going to kind of, split the cost of college. But that's a few years away. So
Well, if we continue to do this every 6 years, the next
there we
time we get
go.
together, you'll have an 18-year-old. We'll see how it worked out. So,
Perfect.
David, thanks so much. I know that there's so many that are going to find value in this conversation, and I look forward to doing it again. Hopefully, we shorten up the time between interviews.
Yep. That sounds great.
We'll see you, my friend.
Yeah.
That's a wrap.
Cool.
Right at 12. Woo!
Awesome. All right.
Did it.
Cool.
Hey, is there any, I always like to ask, especially I haven't talked to you in a while, is there anybody that you might be aware of or connected to that you think might be a good fit for the podcast that maybe I haven't interviewed yet that I could reach out to?
I'd have to think about it. So you mentioned Michael, like usually like me and Michael and Wade are
I've
the
had
one guys.
Michael Wade. Yeah, I've had, yeah.
I'll have to think. I'll have to think.
Well, that's what becomes a challenge when doing a retirement podcast. And it's like, all right, who else
Yeah.
am I going to bring in?
Yeah. Yeah. Yeah.
So, well, if anybody pops into your head, let me know, and
We'll do.
you know, enjoy the sledding today.
Okay, I'll see you.
See you later.